actually, the question we've been asked, can you have economic growth without quantitative easing, and vice versa? And of course, it's a truism, you can have economic growth without quantitative easing. So in fact, the question, possibly more appropriately, not to criticise your fine question, is to say, what has quantitative easing done for us? Has it done anything for us? And that, I think that's a question that I've really struggled to get to grips with. And actually, you heard it first here, I've persuaded Andrew Tyree that the Treasury Select Committee needs to do an inquiry into quantitative easing for that very reason. Not because the subject's complicated, but because the implications of it are complicated. And what we have at the moment are really only pieces of thorough research done by the Bank of England themselves, which is actually a bit like asking, you know, Google to investigate their own activity on the internet. It's really not necessarily the appropriate kind of body to investigate their own activities. But I thought I would just kick off with, I thought, a natty little quote, which is that Bernd Widig, in his natty book, Culture and Inflation in Weimar Germany, said, next to language, money is the most important medium through which modern societies communicate. So, of course, he then goes on to argue that all economies require that we trust strangers. So, you know, I make widgets and I sell them to you. You trust that my widgets are going to work in your car engine or whatever it is you're producing, and then somebody buys your car and trusts that that car's going to work. So actually, money is the medium through which we all interact in an economy. And so, of course, trust in that medium of transfer is absolutely key. And the big fear, that big sort of concern that's there in the back of all our minds about printing money, which quantitative easing isn't technically printing money because you don't actually print notes, but expanding the money supply in such a way is, to a certain extent, debasing the currency, and to the tune of potentially 375 billion, or a third of all UK government debt. That's quite a large sum. And as Peter Sand said, who is the chief executive of Standard Chartered, he said, the risks to financial stability from this kind of intervention is unknown, but intervention on this scale will have repercussions. And that's really where the big banks are on this subject, is it's all kind of, this is going to do something, but the question is what. So what the Bank of England say, they did a report on their first 200 billion QE, that was QE1, so you know, we've had QE2, it's fantastic, it's almost like a cruise liner or something. They reckon that QE1 raised GDP by between 1.5% and 2%, and raised inflation by 0.75% to 1.5%. So the Bank of England will argue that they prevented a double-dip recession, and the trade-off was a bit of inflation, so it was a good trade. Gilt yields, on the other hand, depending on who you talk to, declined by between 26 and 100 basis points as a result. So what does that mean? That basically means that what the Bank of England did was to go into the market, buy gilts, and not only from British holders of gilts, you know, also from foreign holders of gilts. So it wasn't only that printing of money didn't only benefit British banks, but they went into the market, they bought gilts. And what worries me about the Bank of England's approach to this is, what worries me about the Bank of England is that it's stuffed full of economists and not market traders. So when you ask the governor of the Bank of England, what did that do? He said, well, you know, it put money into the economy. And what he doesn't really acknowledge is what it also did was, when you're a buyer of gilts, a big buyer of gilts, as the Bank of England has been and continues to be, what that means to the market is, yippee, we can put the price up so we can sell gilts for a higher price, which means that pushes the yield down. So, you know, it's uncertain as to the impact that that's had, both on the absolute return on gilts, but also on the yield curve itself. And that's where I think the Bank of England really needs to consider its own analysis, because what I've done on the Treasury Select Committee a couple of times now is to try and get the governor to talk about the unwind. Because if I sell you something, and I'm a trader, and so you're a big buyer, I know you're a big buyer, I know you're not a seller, so I decide to sell to you at a higher price, and as you continue to buy, I put the price up and the price up and the price up. And then the day comes when you may choose to, I may choose rather, to become a seller. And so what are you going to do in the market? You're going to think, right, excellent, I'm now going to buy these back at a significantly lower price or higher yield. So obviously, if you've made money on the sale and you make money on the repurchase, then there is a loss. So regardless of the fact that we have printed money, it's not a circular trade, okay? There is a loss or a profit to be made in the unwind of the gilts. And you might think, oh, well, it's only going to be to the tune of 40 or 50 billion quid. It really couldn't matter less what's 40 or 50 billion quid between friends. But surely we need to be talking about that and considering that fact. That's simply market economics, and I don't think the Bank of England had considered that. And in fact, what the Governor prefers to say is that actually it's a liability of the Treasury, it's an asset at the Bank of England, so it's circular, so we can just sort of cancel it. But actually that's only true if you allow the gilt to be held them to maturity, and then the Treasury repays the gilts and the Bank of England repays the Treasury. And even then, you still have the issue of you have effectively debased your currency, or you've had a rights issue within your company that is your economy, and you haven't allowed your holders of those rights, i.e. the people, all of us, who have money and assets in the UK, to take part in that. So you've debased all of our holdings. So this is where the other question comes in, is what has been the impact on people like savers and pensioners? And here again, the Bank of England's view is, don't look at what the impact is, look at what the counterfactual is, which is the first time I'd heard that word really in sense of a justification for a policy, and I thought it was fabulous because it's kind of saying, you know, I shot you, but actually think if I hadn't shot you, you might have had a miserable life. So you know, therefore it was perfectly justified. So this again is an area that we seriously, on the Treasury Select Committee, I'm joking slightly, but these are deadly serious issues. You know, the Bank of England have said people would have been so much worse off if we hadn't done this, that actually doing it was a sensible thing, and you simply can't challenge the fact that all those people who saved for their retirement, all those people who've done the right thing and not borrowed and become zombie households and zombie companies, they have all been made to pay the price. And there's some more complicated arguments about pensioners, where because the value of your assets has increased, it doesn't matter that the yield has decreased, which again is really sort of semantics. And there's no doubt that savers and pensioners have paid a huge price here. Now again, you could argue that's only like other monetary policy, which is another area that the government will say it's only monetary policy, it's like raising interest rates or dropping interest rates. There's always winners and losers. But the difference on this occasion is the market impact. So the day that the Bank of England decides to unwind this position, you get a sudden jump in the yield curve because suddenly the market knows that the bank is a seller. So I hope that that has made some sense. That's me speaking as an ex-trader of about 25 years. But there are then some other considerations. So if we say that's been the impact on trading, on the markets themselves, but what about the impact on, for example, small and medium businesses? And here I was trying to find, you know, have we seen a massive increase because we've put all this money into the hands of the banks? Have the banks therefore lent it to small and medium-sized enterprises, which is what we want them to do? And of course we know the answer to that is no, they haven't, and this is where the real problem lies, is access to finance. So they haven't done that. Have we found that the unemployment rate has been significantly less impacted as a result of low interest rates leading to less businesses going bust and so on than in previous recessions? And again, the answer to that is no. And in fact, I've got the statistics. If you look at Q2 1990, unemployment was 6.9%. Q2 1992, unemployment was 9.8%. Virtually, well, very similar. Q1 2008, unemployment was 5.6. Q1 2010, 9.1. So very similar. The impact on unemployment of a recession hasn't really been altered by QE, so it hasn't really favoured the unemployment rate. So therefore, has it favoured business starts and failures? There it gets quite difficult to follow because the statistics have become rather complicated over the period of time, but there doesn't seem to be any evidence that business failures have been lower as a result of QE. So the fact that we've expanded the money supply, we've put money into the hands of banks, doesn't seem to have benefited the failure rate or indeed the start-up rate of businesses. And then the final question is house repossessions, another very great indicator of economic strength. And here there is some good news in that we haven't found that there have been as many house repossessions as in other recessions. 1990 to 92, house repossessions went from 0.47% to 0.69%. 2007 to 2009, they went from 0.22% to 0.42%. So arguably, house repossessions haven't been as bad, but surely that's because the base rate's at 0.5%, isn't it? It's not because of quantitative easing. So it's very hard to see, from my point of view, as things stand right now, how quantitative easing has benefited economic growth. And that's what the question is. What it clearly has done, it has put money into the hands of banks. But as I said at the start, not only British banks. The Bank of England didn't only allow British banks and British holders of gilts to sell assets to the Bank of England. They were buying them from the marketplace generally. So it's also hard to see whether British banks were the beneficiaries. And of course, the issue for the banks has clearly been one of that massive funding gap where they were funding overnight something like, I don't even want to give the number, it was so vast, it was something like 4,000 billion. It was some unbelievable sum that was being funded overnight. And actually, when you look now at the funding gap, it's only halved. So it's still utterly beyond belief massive. So actually selling those assets has in some way helped banks to do better than they would otherwise have done. So to use the Bank of England's kind of counterfactual argument, I think the only argument that's strongly in favour of QE is that it has avoided an even worse financial meltdown than if we hadn't had QE. So as far as I'm concerned, the jury is very much out, and that's why I'm very keen that we have this Treasury Select Committee inquiry. Thank you.
Thank you very much.